Welcome back to Investing Talk Podcast. Our mission here is always to help you cut through the noise, unpack complex information, and get straight to the crucial insights from a stack of diverse sources. Today, we're diving deep into a question many of you might be asking. Is Ideal Power a good time to buy now? We've really scrutinized a wide range of information for you, everything from fundamental financial analysis and valuation metrics to technical indicators and the very latest news. Our goal is to give you the clearest possible picture.
Exactly. We'll lay out Ideal Power's current standing, its future prospects, and perhaps most importantly, the significant risks involved.
Yeah.
Our aim is for you to walk away from this conversation feeling, truly well-informed about this particular stock.
Before we jump into the fascinating details, if you find this discussion valuable, please consider subscribing, liking, and leaving us a comment. It really helps us bring more of these insights to you. And if you'd like to support us further, you can consider buying us a coffee. Also, if there's a specific company you'd like us to look into next, please leave a comment below. We're going to cover a lot of ground today, so let's get right into what we've uncovered about Ideal Power. Okay, let's start at the very foundation. Ideal Power's current financial health. When we talk about fundamentals, we're essentially looking at the core business performance, right? The engine of the company. What do the numbers tell us about their revenue, for instance? Is there a significant top line here?
What's truly striking here, and frankly, quite alarming, is the revenue picture. For the trailing 12 months, Ideal Power reported an extremely low figure, only about $19,300.
19,000, that's...
Wow. Yeah, $19,300. To put that in perspective, that's barely enough to cover a single employee's annual salary, let alone run a public company developing advanced technology. And it's not just low, it's a precipitous decline from $198,871 in 2023 and $86,032 in 2024. This isn't just slow growth, it's a very negative growth trend, indicating a severe contraction in their sales.
A drop from nearly $200,000 to just $19,300 in a year is frankly startling. That almost suggests a business struggling to even, operate. With revenue numbers that low, profitability must be an absolute uphill battle, right? Are they making any money at all, or are they deep in the red?
Unfortunately, deep in the red is probably an understatement. The company is experiencing very large, consistent losses. Their net income for the trailing 12 months is around negative $10.65 million.
$10 million in losses on $19,000 in revenue.
Exactly. But it gets even more concerning when you look at the margins. Their gross margin, which is what's left after subtracting the cost of goods sold from revenue, is a staggering negative 189%.
Negative 189% gross margin. That sounds almost impossible. Can you maybe break that down? What does that actually mean for someone trying to grasp the severity?
Absolutely. Imagine for a moment you're trying to sell a product. A healthy company wants a high gross margin, right? Meaning they sell something for $10 that costs them maybe $3 to make, leaving $7. A negative 189% gross margin, like Ideal Power has, means that for every dollar of revenue they do manage to bring in, they're actually losing almost $2 just on the direct costs associated with producing or delivering that revenue.
Okay, so it's
It's like buying ingredients for $3, making a glass of lemonade, and then selling it for $1. It's fundamentally unsustainable.
Gotcha.
And their net profit margin, which accounts for all expenses, is approximately negative 55,199%. This isn't just unprofitable, it's basically a financial black hole. It indicates their core business operations are burning through cash at an alarming rate, posing a fundamental threat to their very existence.
Wow, that really puts it into perspective. It sounds almost unsustainable. So with such a grim financial picture, you have to wonder if there's any silver lining or perhaps even a strength. For many companies, debt can be a huge burden. What's their situation like on that front?
Well, this is one area that, appears positive on the surface. Their debt-to-equity ratio is 0%, which means they currently have no traditional debt burden.
Okay, no debt. That's something.
It is, but it's unusual for a company with such low revenue and massive losses because it immediately raises an important question. How are they funding operations if they're not generating revenue, not making profits, and not taking on debt?
Right. Where's the money coming from?
Exactly. It suggests they are likely relying heavily on equity financing, issuing new shares, which can dilute existing shareholders over time. So while no debt sounds good, in this context, it just points to another financial puzzle.
That's a great point. It's not a straightforward positive in this scenario. And what about cash flow or any projections for future earnings? Can we get any sense of where the money's actually going or what's, on the horizon?
Cash flow isn't clearly reported or available, but those immense losses strongly imply negative cash flow. They're absolutely burning cash.
Right.
As for future earnings, there is simply no clear positive projections from analysts. Their earnings per share, or EPS, and price to earnings, or PE ratios, well, they're not applicable because of their ongoing significant losses. When these fundamental metrics are not even calculable, it means there's a complete lack of earnings visibility, which is a massive red flag for any potential investor.
So we've laid out the financial struggle. What does Ideal Power actually do? What's their core business, and where do they fit into the broader industry landscape?
Okay, so Ideal Power is focused on developing bidirectional solid-state switch technology for power electronics. This technology has some very promising applications in significant growth sectors, like electric vehicles, renewable energy systems, and data centers.
So potentially hot areas.
Potentially, yes. The problem is, while the technology is interesting, the industry itself is highly competitive. They're up against many larger, more established advanced tech players who have vastly greater resources, R&D budgets, and market penetration. So while the technology itself might have potential, their current financial state makes it extremely challenging for them to compete effectively in such a crowded and capital-intensive space.
So we've painted a pretty stark picture of Ideal Power's financial health. They're battling shrinking revenues and significant losses. But what about how the market is actually valuing this company right now? This is where it often gets quite interesting, or perhaps perplexing. What did the valuation metrics tell us despite those challenging fundamentals?
Well, given the negative earnings we just discussed, the price to earnings, or PE ratio, isn't available, which, as we mentioned, is pretty typical for loss-making companies. It just reinforces that current profitability isn't really a factor in their valuation. However, the price to sales, or PS ratio, stands out as truly astronomical, approximately 530 times.
530.
Yeah. This isn't just high. It's a figure that demands a double take. To put that in perspective for you, a healthy, rapidly growing tech company with solid fundamentals might have a PS of, say, 5 to 10, maybe 15 if it's really hot.
Okay.
For Ideal Power, with its shrinking, almost non-existent revenue, this 530x figure just screams speculation. It powerfully suggests that the stock's valuation is far, far above its current revenue. It's like valuing a startup based purely on the hope of a breakthrough product eventually generating Fortune 500 level revenue, rather than any current or even near-term performance. Investors are essentially betting on a massive future payoff with very little, if any, current justification.
Wow, that really highlights the speculative nature. So with that kind of PS, what about their price-to-book ratio? Does that offer any more grounded perspective?
The price-to-book, or PB ratio, is about 2.6 times. This is modest in comparison to that PS ratio. However, without profitability, it's not very informative for a company that's supposed to be a growth stock focused on technology. Price-to-book usually indicates how investors value a company relative to its net assets. But in a tech company that needs to innovate and grow, assets alone don't tell the whole story, especially if those assets aren't generating revenue or profits. If we connect this to the bigger picture, it means investors are valuing the company based on something much more intangible than its current sales or even its underlying assets. Furthermore, there's a distinct lack of strong traditional valuation support. Discounted cash flow models or definitive target prices for the stock are simply not available from most analysts.
So analysts aren't really putting price targets out there.
Generally, no. This absence signals that professional analysts find it incredibly difficult to project Ideal Power's future cash flows or earnings with any reasonable certainty, making a fundamental valuation extremely challenging. The market capitalization is modest at about $48 million, which, again, when viewed against the dismal revenue and losses, likely reflects more speculative interest and pure hope for a breakthrough, rather than any strong underlying value that would attract long-term fundamental investors.
So we've established the core financial struggles and the highly speculative valuation. But what about the day-to-day action? What are the charts telling us about how this stock is actually moving in the market? Let's talk technical analysis.
Okay, looking at the charts, the current price is around $5.73. It's sitting within a 52-week range of $3.77 to $9.69. This immediately tells you it's seen some significant swings over the past year.
Quite a range.
Yeah. It also shows moderate to high volatility with approximately 7.35% weekly average daily volatility. That means on any given day, the stock can swing quite a bit, which can be enticing for short-term traders, but very unnerving for long-term holders. Plus, intraday swings average about 3.87%, so even within a single trading session, you can see significant price movements.
That's quite a bit of movement for traders. Are there any positive signals coming from these movements, perhaps from things like moving averages?
Interestingly, when we look at moving averages, both short-term and long-term averages are currently giving what are technically considered buy signals, with the short-term average positioned above the long-term one. This might initially look encouraging to some, suggesting a positive trend.
But there's usually a catch with highly volatile stocks, isn't there? What else do the charts reveal that might temper that optimism?
Indeed, there's a crucial point of caution. There was a recent sell signal generated from what I called a pivot top on July 10th, 2025. A pivot top occurs when a stock's price reaches a high point and then begins to fall, signaling a potential reversal in the upward trend.
Okay.
This particular pivot top led to about a 5% price decline, acting as a clear warning sign. Key support levels, which are price points where a stock tends to find buying interest, appear to be near $5.76 to $6. A breakdown below these levels could trigger further sell signals, making these critical points to watch for anyone considering a trade.
So watch that $5.76 level closely.
Definitely. Furthermore, the MCD, or Moving Average Convergence Divergence, which is a momentum indicator, is technically positive. However, we're seeing something crucial: divergence.
What does that mean, divergence?
It's when the stock price might be trending up, but the MACD indicator itself is moving in the opposite direction, or flattening out. Think of it like the car dashboard warning light coming on even though you're still accelerating. It suggests the underlying momentum is weakening.
Ah, gotcha.
And combined with that recent drop in trading volume, it's a significant yellow flag for cautious investors.
That analogy perfectly illustrates the warning. So despite some seemingly positive technical signals, those divergences and the low volume really underscore a need for caution. Let's move beyond the numbers for a moment. What about the recent news and overall market sentiment surrounding Ideal Power? Has anything significant shifted the narrative or given us a different vibe?
Well, the latest earnings report did technically beat revenue estimates, which, on the surface might sound like a positive. But we have to remember the context. The company still reported significant losses, and those revenue numbers were still incredibly low.
Right, beating a very low bar.
Exactly. Their earnings per share were in line with expectations, so no real surprises there on the loss front. It was more of a less bad than expected rather than genuinely good news. We haven't seen any major analyst upgrades since that report, and the general consensus rating for the stock remains hold. This indicates a wait-and-see approach from the broader analytical community, which isn't exactly a ringing endorsement for a stock with such extreme financial challenges.
A hold rating isn't exactly inspiring confidence.
Not really. Furthermore, there hasn't been any significant insider activity reported, meaning those closest to the company haven't been buying or selling in notable amounts, which can often signal confidence or lack thereof. Nor has there been any notable social media buzz suggesting a lack of strong, widespread conviction from the retail investor crowd. Overall, the stock is generally labeled by most sources as very high risk and is well known for its high volatility, which is certainly consistent with everything else we've observed.
Given everything we've discussed so far, the financial struggles, the speculative valuation, the mixed technical signals, and the muted sentiment, what could potentially change Ideal Power's trajectory. Are there any upcoming events or developments that could genuinely act as catalysts and shift the narrative, either for better or worse?
Well, the nearest and most concrete potential catalyst is their next earnings report, which is due on August 13th, 2025. For any stock, earnings reports are significant, but for one with such a volatile financial picture and high cash burn, this report will be scrutinized intensely. Any surprising news, positive or negative, could trigger a sharp reaction.
So August 13th is a key date to watch.
Absolutely. Beyond that, for long-term potential, the advancement and broader adoption of energy sector technologies, particularly in EVs, grid stability, and renewable energy storage, could be a significant catalyst. Ideal Power's bidirectional solid-state switch technology is positioned in these areas. Also, broader market adoption of their specific solid-state switch technology, proving its superiority or cost-effectiveness over existing solutions, could be a key long-term driver.
But that's more of a long game, right?
Exactly. It's crucial to note that there aren't any specific product launches, major partnership announcements, or mergers and acquisitions announced at this time. So these remain more speculative, long-term hopes based on market trends rather than immediate concrete catalysts directly driven by the company.
So we're talking about a lot of ifs and hopes for the future rather than immediate tangible breakthroughs. Given everything we've discussed, the revenue drought, the massive losses, the cash burn, and the speculative valuation, what are the biggest risks for anyone considering this stock? What should our listener be absolutely aware of?
The primary financial risks are, well, profoundly serious. They stem from the company being consistently loss-making, experiencing what we call cash burn, and having extremely low revenue. Let's really unpack cash burn. This means Ideal Power is consistently spending significantly more cash than it's bringing in from its operations or sales. With their very low revenue and ongoing heavy losses, they are essentially depleting their cash reserves at an alarming rate.
So they're running out of runway, potentially.
Potentially, yes. Without a fresh influx of capital from investors, usually through selling more shares, which dilutes existing shareholders, or a drastic and rapid shift to profitability, this burn eventually leads to insolvency. They simply run out of money to operate. This significantly heightens the overall financial risk, making it a constant existential concern. Beyond the fundamentals, the stock's volatility is high. Its average beta is around 1.0, which means its price movements are generally correlated with the broader market. However, because of the low trading volume and speculative interest, its individual price swings can be quite sharp and unpredictable, exposing investors to rapid value fluctuations.
That beta sounds almost average, but the real-world swings are much bigger.
Kind of, yeah. The beta suggests market correlation, but the day-to-day percentage moves can be significantly higher than the market due to its specific circumstances and low volume. For short-term traders, there's even increased risk due to that low trading volume we mentioned and those price divergence warning. Low volume means it can be difficult to enter or exit positions quickly without significantly impacting the stock's price, potentially leading to unfavorable fills. The divergence signals, as we discussed, suggest a weakening of underlying momentum, which can trap traders who rely solely on surface-level technical indicators.
Right, that warning light again.
Exactly. And finally, there are broader sector risks. This isn't just about Ideal Power's internal struggles. The challenges of technology adoption in the energy sector can be slow and expensive. They face intense competition from larger, more established incumbents, like the major players in electric vehicles or power electronics, who have vastly greater financial resources, existing customer bases, and brand recognition. And of course, potential regulatory developments in the energy sector could either open up opportunities or pose significant new challenges to their niche.
So what does this all mean when you put it together? If someone came to you today asking, is Ideal Power a good time to buy now? What would be your overall assessment? How would you rate it?
My rating for Ideal Power would be a 3 out of 10. This is based on the severe unprofitability, the negligible and shrinking revenue, the complete lack of earnings visibility, and the very high trading volatility we've observed across all our sources.
A 3 out of 10. Pretty low.
It is. Ideal Power currently appears to be a very high-risk speculative stock. Its poor fundamentals, particularly the significant cash burn and lack of profitability, mean it's just not suited for long-term investors looking for stable growth or a company with a clear path to generating returns. Instead, it's almost exclusively for high-risk short-term traders or speculators who can genuinely tolerate significant volatility and, crucially, who are prepared for the very real possibility of substantial or even total loss of capital.
So definitely not for the faint of heart or the traditional buy and hold investor.
Absolutely not. For those extremely speculative trades, and only with robust risk management, technical support between $5.75 to $6 could be considered a possible entry point. But I cannot stress enough, you would need clearly defined risk management in place. A recommended stop loss, for example, would be around $5.75. That's approximately 4% below the recent price, designed to limit downside based on that critical support level we talked about.
So very tight stop loss.
Extremely tight. Given the extreme volatility and the complete absence of clear target prices from analysts, a cautious 10–15% upside target might be considered. However, due to the technical corrections and those worrying divergences we discussed, even achieving small gains is highly uncertain and comes with outsized risk. If we connect this to the bigger picture, it means even for a short-term trade, the risk-reward isn't overwhelmingly compelling. In summary, if you're considering a position in Ideal Power, robust due diligence and extremely tight risk controls would be absolutely essential. It's truly for those with a profound understanding and high tolerance for extreme risk, and it absolutely requires an exit strategy before you even consider entering.
This analysis of ideal power truly underscores the difference between pure speculation and a genuine investment, doesn't it? What's fascinating here is how much information you need to weigh, and how crucial it is to understand your own risk tolerance before making any moves in a market like this. It's not just about the company, but about your own financial position and your ability to absorb potential losses.
That's exactly right. Know thyself, especially with stocks like these.
We hope this breakdown of ideal power has given you a much clearer, more nuanced picture of what's happening with this stock. Remember, knowledge is your most powerful tool in the market. Thank you for joining us on this financial journey, and we look forward to exploring more with you next time on Investing Talk Podcast.